but a lot of what he speaks about can apply to other areas of the business. So some great expertise is going to come from Ryan. We have our COO, Tara, who is just an expert when it comes to everything process, documentation, and operations. So we can't wait to share that vital knowledge that we benefit every day here at Amplify with the rest of you. So had to pull her a little bit to get her to come out and talk to you, but I'm so excited that she's agreed to do that. And then of course, you're stuck with me from a perspective of the you're stuck with me from a perspective of financial strategy and the overview of financial strategy. And then we have Jordan that will represent our tech side of things and how to think about when you need an ERP and other automation and technology side. So people, process, technology, facilitated by Greg and talked about with your Amplified crew, which is super exciting. The month after that, we actually have Jeffrey Kahn. He's a worldwide known author, and he's going to come and talk to us about digital trends. So if you haven't heard of Jeffrey Kahn, I highly recommend that you take a look at his LinkedIn or take a look at his website. He is an absolute expert, and it's amazing that he's agreed to come and talk to us. So that is happening in April. And then we also have some documentation, note-taking, and risk and controls considerations coming up with Adrian. We've got a strategy coming up with Pete and a whole bunch of other things. So definitely pay attention to what's happening because it's a lot that's happening. But let's jump into today's. So we're going to talk about this 5 C's of commercial lending in the eBook that the 4 of us wrote last year. So it's very exciting to us that we were able to update it and we're able to join you again on this important topic. So for many of you, you've had a chance to download that book, and I think Ryan just shared it with you so that if you haven't downloaded it, please do take a look at it after today's session, because there's a lot of details that we're not going to have time to get into. But really, the 5 C's of commercial lending is a lens or a tool that we put a fulsome book together on, because it's an interesting way to look at your own business and also to put yourself in the shoes of lenders or advisors or investors. So how do they look at your business? And one of the ways they look at your business is with those 5 C's. So if we just do a quick recap, I'm actually going to share my screen and show this to you quickly. So this is our book in action. Can you see the book, Chad?
Yeah.
Okay, perfect. So just quickly, from a character perspective, it's the reputation of the borrower. So you as the borrower, what is your reputation? What is your credit history? Who is your management team and who are your people? And that matters to those that are investing in your business, be it through debt or equity. Collateral, that is pretty straightforward in terms of it being the assets that secure the loans and provide assurance. And of course, with equity investors, what is the collateral? That's the given assets that are there that are part of what they're investing in. Capacity, which is the ability to repay. And so that's really the quantified, what are the debt ratios? Are you able to actually look at debt service costs, and when will there be a return to the investor? So capacity is incredibly important and will vary a lot depending on who you're talking to. Some people have short-term needs and other people have a longer term timeline in terms of their return. Capital is the direct contribution to the investment, such as a down payment. So it's really your skin in the game. If you're asking for $1 million equity, are you putting up 100,000 this month too? If you're asking for a mortgage, what's your down payment on that house, etc. And lastly, it's conditions, and that's the terms and details of the loan, how you're going to use the money, and the economic circumstances that you find yourself in. And of course, in today's world, that conditions is very volatile and interesting because we seem to never get out of a pandemic. So those are the 5 C's, and you can read about them more, and we'll drip feed them a bit in today's discussion as we talk about what we're seeing in the economy. So without further ado, I'm going to turn to each of you to introduce yourself, and then we'll get into the details. So Chad, you're off mute, so why don't we start with you? Who are you, and what are you going to achieve today?
Yeah, thanks, Jamie. So my name is Chad Dell. Thanks for inviting me again. I'm happy to be back. I'm a senior account manager with National Bank Commercial Banking Group. Been in the banking sector now for about 20 years, going back to my personal and and retail banking days for the first 10 years, and then commercial banking focus for the last 10 years, because that's where all the action is. So obviously, we've seen a lot of challenges over the last few years, and we've been happy to help some clients navigate through challenges, and looking forward to what's next.
Thanks, Chad. Daniel?
Hey everybody, so my name is Danilo Terra. I'm a director of equipment finance with ATB Financial. So everything to do with equipment and equipment financing, I love for our banking customers and our non-banking customers too. We'll just do one-off equipment deals, and essentially I believe companies should have the equipment they need to be successful, and we provide the financing for that. Generally, we deal with Alberta-based companies, being ATB, but our equipment can be domiciled. It can go anywhere in North America, so Canada and the US. So it's definitely been an interesting environment in the equipment world and multiple industries. We deal with all sorts of equipment, generally serialized and marketable equipment, but sometimes we get into the specific things. And yeah, there's been a few curveballs left and right, which we'll chat about, I'm sure. And yeah, thanks. Great to be on here.
Thanks so much. And OT, you're familiar to many of our guests because it was only a couple months ago that you joined us, but if you could introduce yourself, because there's probably new people.
Sure. Hi, everybody. It's Othello Twassen. Most everyone, as you can hear from Jamie, call me OT. I'm the principal and founder of Nautilus Endeavors, which is an independent or boutique corporate finance and corporate development shop. What does that mean? I help private companies with buy, sell, their divisions or full companies, so succession planning as well too. I also do private placements, again, private markets, so debt and equity. So banks are a very important part of sources of capital. What I'm hoping to accomplish today is just a little bit of color of the deals that I've been working on this last year. There's definitely, I don't want to call them trends. It might be too early to call it a trend per se, but there's definitely some interesting statistics that have been popping out that it relates not only to the 5C's, but deals in general. So looking forward to having a conversation with everybody.
Awesome, that's great. So Chad, why don't we go back to yourself? You obviously are a representative from the financial institutions on a national level, being National Bank and one of the bigger banks that we see in the country. And I'm curious to know, what are the trends and surprises? Maybe you could name three, for example, that you're seeing when it comes to your interactions with clients and risk and credit, and what your expectations are in regards to this pre and post-COVID world that we live in. What do clients need to expect that you're going to expect of them, and how can they tell their story better?
Yeah, it's a great question. It's you know, there's much more. There's many more than three, and I would agree with OT. You know, I'm not sure it's a trend, but it's definitely something we've been putting more focus on, especially over the last year or two than we did before. I mean, the one thing that comes to mind right away is that no matter what sector you're in these days, you're likely looking at a scenario where you've seen increasing costs, whether it's from supply chain challenges or from inflation, or from interest rates. And obviously, the Feds basically weren't too shy about saying that while they were holding interest rates steady for now, they will be increasing. And so what we've been looking at quite often lately is basically building that anticipated increase in interest rates into the financials that we're looking at right now, just to see what the level of impact that's going to look like, and if the borrower is going to be able to absorb it.
And so if we pause on that one for a second, if we're building a forecast before we approach you, what are the levels of increases and the timing of those increases that you would anticipate to see in a forecast?
I think, you know, conservatively, I would build in a 1% increase. You know, we're anticipating, I think, you know, it could go from a half a point over the next year to a full percentage point up. But I mean, if you look at, you know, prime rate right now is 2.45%. If prime rate were to go to 3.45, that may be a little aggressive, but if it did, that would represent about a 30% increase in cost of borrowing. So that's pretty significant. But I would say between half a percent and 1 full percent.
Half to one. Okay, no, that's interesting. So increased cost is definitely a trend, and it's interesting because we just had Carolyn, actually, one of her LinkedIn posts was featured by LinkedIn News about inflation and shrinkflation. And it's interesting how it affects both what your own pricing, right? And I think a lot of businesses would be smart to take a look at their own pricing and get ahead of this and think about how inflation could be a bit of an opportunity to make an excuse for higher prices that you're probably overdue to increase anyways. And then obviously anticipate that your cost of goods sold is likely to rise. And for some of us, we've done a great job of business partnering and putting ourselves into contracts that reduce the risk or volatility in the short term. But I think there's no one that isn't going to be subject to it hitting us in some capacities at some point. And if you're lucky enough to have a fixed contract or a contract that reduces that volatility, you still have to anticipate when it's going to hit your cost, not if. Anything else that Otello or Danilo have seen in terms of costs that they want to add?
Yeah, I'll jump in. It actually tied into one of my other comments, but happy to share it here. I have a client that relies heavily on transportation. He has products that come from Asia. So obviously you need sea cans, and trying to get your hands on sea cans this last couple of years has been pretty tough. It used to be 24 months ago, you can get a sea can for about $2,000 to $2,500 USD. And now the cost is tenfold. It's about 25,000 USD for a sea can. So a lot of his inputs have increased in cost, not necessarily the products themselves, but tacking on transportation, landed costs are up. And here's the good news, bad news. Everyone knows about inflation. Everyone's been watching it. So he's had to do one of two things. One, he's pulled back a little bit. I've seen him still be aggressive with his client base, but actually change the timing of delivery because of, again, just not getting the product. Number two, he's been able to pass through these costs. And I find that fascinating because it's actually a true knock-on effect that his clients are seeing inflation because he's not going to absorb it on his own. So again, there's this double-edged sword that, we've been hearing and listening to pundits suggesting that this is a temporal cost impact related with shipping and pandemic. But arguably, when you're seeing flow-throughs like this, it actually could be more systemic change in costs. And I think that's another reason why we are going to see some cost of capital increases. And, back to Chad's crystal ball, his guess good as mine. What I'm hearing from other call it experts in the field, economic experts in the field. Yep, I wouldn't be surprised if you see something north of 50 beeps, but 100 would probably be aggressive. So same notes I'm hearing, substantiated by pass-through costs that Main Street is having to do to keep their margins.
Awesome, that's very helpful. So Chad, going back to our original question, so as you approach things, as you approach packages with your risk and credit committees, for example, or sorry, departments, I guess I should say, what are the top asks or the trends or the surprises that you're seeing right now? Anything unusual or worthwhile for us that are helping you put that package together to think about?
I suppose I'm pleasantly surprised with what I've seen from my perspective, just the resiliency and the adaptability of businesses. Obviously, there's a lot of noise and a lot of pain out there, but I've been pleasantly surprised by some of the companies who have done well through the pandemic. Then I guess the question turns to, well, how sustainable is, if you have been able to thrive through the pandemic, as we continue to the situation continues to evolve. At the end of the day, as a lender, we're always looking to try and normalize the numbers. And if you see a lot of variation from one year to the next, then obviously it becomes more difficult to normalize. So at the end of the day, what my expectations are is really to here's the numbers and try to do a deeper dive into what those numbers are telling us. And sometimes that involves having a deeper dive on a forecast. So for example, if you haven't been forecasting, that's something, you would definitely would be a good practice, even if there's no bank involved. I know if I was a business owner and I had no debt at all, I would still want to kind of have some sort of a forecast. The challenge or the difficulty people come back to me with is forecasting as well. We just don't know how accurate it's going to be. But my reply to them is always, well, some sort of forecast is better than none at all. And you'll find that, even if you haven't done it a lot before, you will get better at it as you go along. And then you have to think about, well, where does this forecasting come from, right? Is it purely based on historical figures? Is it based on contracts or WIP, or a combination, or other factors entirely? So really, what we're looking at is, it's just taking a deeper dive to see what the numbers are telling us, and what we can extrapolate from them going forward.
And Dan, obviously you have the luxury of better collateral than the majority of lenders because you're in the business of equipment. But is there anything, to Chad's point, that you are seeing at ATB or that you would add on to?
Yeah, a couple points there. Chad's bang on everything. Forecasts are important. We can't lend in the forecasts. We are looking in that rearview mirror a lot of times, but they sure help us. So and having something there is really important. We still see a lot of clients without any sort of budgets or forecasts to provide. Tell that good news story coming out of COVID. Tell us about those contracts. How does that translate into the numbers we're seeing? If you want additional equipment, that equipment's going to hopefully make you money. We'd like to see that, going forward, showing in those forecasts. Further to his costs, I know we're quoting fixed rates generally on equipment, so people can fix their costs through the life of that loan or lease, especially on leases, all fixed rate. And we're seeing that increasing dramatically as well. There was a time, if you asked me for a quote, I would hold that interest rate. I'd win or lose a little bit depending on when you actually pulled the trigger on the financing. But we try and keep true to our quotes, even though it says subject to change on that. Nowadays we just can't. We just find we're getting burnt holding rates for even a few days. So it's really day to day on the fixed rates. Yeah. So
that I didn't realize. That's interesting. Chad, are you seeing the same thing when you guys are putting out proposals?
Yeah, we're pretty careful in terms of well, I mean, we obviously can't lock in a rate until we have a firm credit approval sort of thing. But no, definitely, and there's definitely, we're seeing more people go towards obviously fixed rates now. I mean, we've been working with variable rates for so long, just because the cost of borrowing has been so low. But obviously, going to a fixed rate is a potential way to lock in your costs. As is, working with foreign exchange and hedging foreign exchange. So there are some tools available, and all lenders can provide these tools at very, little, if any, cost to the borrower, just to help them try and navigate some of these challenges. I wanted to just make one more point on the forecast thing, because I quite often get forecasts of 5 or 10 years, and really it's too much. What really needs to be focused on is the next year, and anything beyond that. I mean, I always have a conversation around the borrower with, well, where do you feel you can provide a forecast that would be somewhat accurate, with the caveat that things can change very quickly. But a year typically is what we'd be looking for. Any more than a year out, and it's difficult to really ascertain any sort of level of certainty.
That's fair. That's starting to talk more about strategy than things that you can expect and rely on as a lender, for sure. That's awesome. So Dan, if we turn to you, obviously you're working in the Alberta market in a deep and intimate way, being ATB and equipment lending. And I know that you work with all types of industries, but especially oil and gas services. Is there anything particular about Alberta oil and gas services, or what ATB seeing, that we could talk about, say 3 trends or surprises from your eyes?
Yeah, you bet. Energy services, oil and gas is near and dear to my heart. The last 21 years, being based in Calgary, I was kind of the equipment guy and across industries, but being in Calgary, you're specializing in those sectors, which is great, and I love dearly. But yeah, lots of surprises and things we've seen. I think they're in the headlines daily, so you're not going to be surprised about these points. But The price of oil, it retracted a little bit today, but we're in the 90s. We're going up to $100 possibly more. It depends. Everybody's guess is as good as mine. If Putin's sole goal was to raise the price of oil so that he could make money being on the border of Ukraine, he's sure done it. But a byproduct of that is Alberta. Our exploration production companies are doing well. They're in the money. That translates into the energy services, right? Trickles down to them. So we're seeing, a lot of energy come into that. Some smiles are coming back. Is it another boom? Possibly. Something unique on this one, on this raise in activity that I'm seeing is it's prudent and conservative growth and asks that we're seeing of the banks. So people are really taking a cautious approach to this this raise in the price of oil and renewed activity. Now, many producers, they're making money. What are they doing with that? Well, they're paying down debt. They're doing a lot of dividends. Are they putting holes in the ground? They're going to have to soon. That's what I'm hearing. We feel that the energy services is really going to skyrocket in terms of drilling and those supporting services after breakup this year. So towards summer, June and summer. So right now, rig counts, which aren't affected by weather like we are increasing in the U.S. quite substantially. We've seen a steady trend of that. Canada's not far behind. So yeah, we're seeing that, which is really cool.
Just to interrupt quickly, do you think that people are perceiving it and acting with caution because they think it's their last boom?
I've heard that before. I think we've all seen that one bumper sticker. The renewables, is on the sector's tail. Now, whether we're going to have some ebbs and flows before we all drive electric cars and turn, I think that might happen. This is a testament to one. So yes, I don't think it's our last boom, but I think the future's on the wall, maybe for my children and that. But I think this shows that the world needs a prudent resource-based economy that's developing well. I think Alberta is just a model for the rest of the world. And another point that we're seeing in that sector, the energy service sector, and that, and OT, you touched on it, man. Supply chain, that's a real wild card. That's something that's going to be really impactful, I think, going forward. Yeah, it's going to be on supply chain. We're going to hear it a lot. It's going to be one of the most used, if not already, terms lately. But it's affecting all industries in some way, which is good. But in terms of energy services, that is something that's going to take a shine off this boom. I've already heard drillers saying there's not enough casing for when they do pop new holes in the ground. I mean, the product that's coming out from China, drill pipe, string, and that sort of thing, some specialty materials, that's tough to get, and that's going to really kind of put a hamper on it. Now, not directly related to supply chain is human resources and workers. When they do start drilling again, there won't be enough gear in the province, probably, if they really go gangbusters, but also skilled labor that possibly exited over COVID. And so some interesting things. Some other clients, and the price of metal in certain circumstances is just skyrocketed for a lot of clients, which is interesting. There's certain kinds of metal that only come out of specific places in the world, like Germany. There's special metal that doesn't react with certain products in the oil and gas industry, and it's just not making its way over on the ships. They'd rather take containers, which are lighter. It's just there's going to be there already are some real issues on supply chain. I just want to say on the transportation side of supply chain, I had a conversation yesterday with a trucking client that is essentially getting rid of some trucks because he can't source the trips going into these trucks. He needed new chips. They're sitting there idle, and guess what? They're going into the Ritchie Brothers auction in March. That's interesting to me, where you're getting rid of your moneymaker, your equipment, because you can't source products. or certain components for that. Thanks,
Yeah,
Jeff. Thank you.
that must be so frustrating for that person.
Oh yeah, it was a tough conversation. I really feel for them. What do you do, right? So, and then probably a third point on energy services, oil and gas, that I'm seeing used equipment. That has definitely changed my world as an equipment guy. I mean, you drive a truck or a car off the lot, you expect that the value of that just to skyrocket as soon as you drive it off the lot. That's what your parents told you. In terms of used equipment, we're seeing and sometimes that value of that equipment is going up despite normal use. We have some clients cashing out. They're saying, hey, I can pay off my equipment and make a capital gain on my equipment. Let's cash out on certain types. Appraisals are key. Hey, if the value of your equipment base that you're getting money on or that you're borrowing against is going up, maybe a new appraisal is capturing the latest auction that's showing, some used equipment increases. We had a limo client that they buy the transit vans and then they redo them into specialized limos and RVs and stuff that they rent out. They bought the equipment pre-COVID. They bought the shells, parked them because they didn't need them during COVID. Put 5 kilometers on, resold them to the dealership, and made a profit, which blows my mind. So that's pretty interesting. Now they're kicking themselves because they can't find any new product now that they're getting going. So yeah, it's pretty amazing.
It wasn't meant to be an exit strategy.
Well, yeah, that's my take on a few little points anyways on the energy service industry, oil and gas industry.
No, that's awesome. OT, I know that you work across industries and have a history of probably having lots of oil and gas and energy as well. Not sure about today. Anything that you've seen or that you want to touch on that Dan just mentioned?
Yeah, yes, I've worked with a lot of primary industries, and I'm actually quite bullish for Alberta oil and gas and energy service. Reason being is we're not seeing the mad rush that we typically have with the boom bust cycles. And let's remove ourselves from this commodity. Let's look at forest products. That's another one that I've worked with for many, many years. What we saw back in the 80s and 90s, very similar. You'd find tightening of belts when lumber prices fell, and all of a sudden lumber prices rise and people were spending like sailors and shore leaves, new equipment, new CapEx, new facilities. And what had happened during the late 90s and early 2000s is, I don't want to call it a rationalization, but that's probably the best description of companies of all sizes, that there was more prudent spending, that they weren't swinging as heavy. I'm not suggesting the forest products is anywhere close to calling stable, because it is a commodity driven business, but we're not seeing the same swings in that sector as we had in the past. And if I can call it projecting, I'm hoping, actually that's a better term, I'm hoping that Albertan companies behave the same. Those that have ridden the cycle, and instead of selling now, this does dovetail into some of my findings. They're not selling, and they're finding other exits to wind down, piece off materials and the like. And if we have less players in a smaller market, that is stability. Like CAP is projecting, I think, $32 or $35 billion this year, 20% increase over last year, but it's nowhere close to 2013-14 when that CapEx spend was $85 billion. So there's still money to be spent. The difference is we're not going to have a mad rush and flood, and hopefully the swings modulate a little bit. So very similar view as Danilo on this topic. I'm optimistic as long as we are reasonable and rational with our people and capital deployment. Now that we're looking at $100 oil, and I am calling it, we're going to see it. Absolutely going to see it. There's not enough capacity coming on board.
Nice. So obviously the question that I've had for you, and I know you've touched on a couple of your 3 main points, but just to recap, really curious, since you're working with clients and helping them find the right way of financing, what are the surprises and trends you're seeing from the client's perspective and what their goals are? And maybe there's people in our audience today that could learn from those goals of successful raises or about to be successful raises, in terms of like looking at things a little bit differently and looking at things from the economic seat of today.
Sure. You know what I'm going to do? I'm going to shift that a little bit because I don't want to make it all about their goals, because there's a bit of a response to some of the topics that I'm going to share and their observations. So number one, let's talk about capital, not about the borrower's capital. Let's talk about capital markets. Movement the last couple of years, equity capital markets for transactions that North American track transactions of, let's call it reported, 20% down. Number of deals, 12 months over the 12 months previous, 20% down. Debt capital markets, flat. What really surprised me, and it makes sense when you start hearing stories of things like SPACs and the like that's out there, venture capital and other has been up double, 100% increase year over year from 2021 versus 2020. So it was about 3,000 transactions in North America in 20 and 6,300 in 2021. Venture capital investment globally, 675 billion. And that's double, again, double of the money that was raised in 2020. And what blows my mind is there's over 133 unicorns in San Francisco alone. And for those that aren't unfamiliar with the term, it's a $1 billion market cap, 69 in New York, 20 in Boston, 20 in London. And that has been a massive shift in Europe of seeing unicorns. Usually this is a story quite often reserved for Silicon Valley. So there's something in the water. People are talking about the shift outside of the pandemic. If traditional equity deals are falling, bank or debt deals are stable, people are making some long bets in a shift in the way the economy works. And I think that's probably because of distance learning, distance working, video conferencing. I think there's going to be a major shift in the way we go back to normal. And there are people making some big dollar bets. So I think that's fascinating that there's movement, banking stable, but the equity dollars are moving around in different places.
And who do you think wins when venture capital is the go-to for financing? I think we all know that tech wins. That's undoubtedly tech wins. And frankly, I mean, we can come to you, Chad and Danilo, on what tech, like the problems tech has with getting traditional financial backings from banks. And we all know that a lot of the reason that they go to venture capital is because they just don't get the ear that they need with traditional banking. But besides tech, if we just take tech out of the equation, because I think everyone's read a news article probably this morning on the Peloton about tech. What else, like who else is the winners when it comes to venture capital being the new go-to and the new trend?
Are you asking me or the guys?
You, I'm asking you, sorry, LT.
Well, funny enough, I did have a venture capital deal that I closed this year, and it's tech, but it's not. It was actually I can share it. He's very proud of his story. It's a company that builds robotics, so it is technology, but it's the replacement of people on bucket trucks and helicopters hanging off doing utility work. So it's not high tech per se, but it's smart engineering. So there's a movement towards greater safety. So I don't want to say that it's just the next platform or app or whatever. It's anything that can displace the old way of doing things, higher safety, lower cost. So I guess it's tech. Others, I'm noticing a big movement right now. For example, the city of Calgary, I helped them with placements that they have with some of their venture money. I don't want to call it venture money because it's not always venture, but opportunity funds, so growth money. And there's movements of same old, big company coming in, but I'm going to help raise the profile of this industry within a region. And so government and grants, that's another big movement that it's the same industries, but it's more around employment, and it's shifting back to my point about distance is important. Call centers, service centers, biotech. That's a big movement recently. So it's not necessarily the apps alone. I think there's different sectors of reducing cost and increasing efficiency where money is chasing. And it's that idea again that we don't have to go back to what we used to do. We can do it differently. So there's an innovation lens, if I can use it that way, without using the word technology.
No, it's good. So just if we pause for 1 second and just, Dan and Chad, obviously, what I love about the two of you is you definitely share Amplify's values. And if your institutions aren't the right financiers or lenders, you're the first to recognize when you can bring in friends that are venture capitalists or the equivalent. I mean, in Calgary, how many people define themselves as venture capitalists is a little low. They might be more private equity or alternative lenders or what have you, but the same spirit.
Yep.
And both of you I've seen, be very collaborative in a really courageous way. So who are the people that you find that are better served by those alternatives than your traditional lending that both of you represent?
I would probably echo OT's comments on the tech sector for now. I mean, the challenges around traditional debt lenders with the banks and the tech sector is that I think historically there's just been a general level of somewhat unfamiliarity, just because the tech sector does work a little differently than other sectors. Obviously, quite often you've got a large amount of capital that's required on the R&D side. So there's a lot of costs that happen pre-revenue, and that's always something I think that the banks have historically had a difficult time kind of getting their heads around. Now, that being said, I also think that there's a number of the FIs in Canada right now, my National Bank included, are gearing up with almost kind of a niche division of tech financing, especially in the larger centers like the Torontos and Vancouvers and Montreals and whatnot. But I think that's going to start to change a bit, but that's been a challenge thus far.
Awesome.
Yeah, we're keeping that innovation lens going, and the discussion on tech. Chad, similarly, ATB. Now we have directors, technology businesses, and which is great to see, right? So it definitely is a focus of our bank. Now, what happens in my world when I have to say no? When does that happen? Sometimes it happens when companies are a little more distressed than our credit box allows for. Maybe that they need interest-only payments versus amortizing payments on a piece of equipment. And maybe it's on equipment that I can't really lend against. Computers and phones. There's some great partners out there that will lend on or provide leases on technology equipment for companies and that sort of thing. We can do it to a certain extent as well, but on the startup phase and there's really high growth, so sometimes we can't really accommodate that. So there are some options out there. I know I personally love providing. If I can't help, hopefully I can send you to somebody that can, right? So there are some innovative, they tend to be the private equipment leasors, and that provide true residuals on equipment where you can hand back equipment. And these are amazing organizations. Well, they'll take back technology, white power drives, redo it, and then refurbish it, send it off to somewhere else. So really, really interesting, I guess, applications beyond the banks in terms of where to find capital and that sort of thing.
Awesome. So, back to you. That was obviously really incredible insights and some trends that I think we do need to watch out for. And maybe as you're approaching who it is you want to think about for investors, those are some pretty key trends that people might not have been aware of, and they might have changed the way they start their story and who they call first, etc.
Yeah, I appreciate the input from the other guys here. The other two bits, I'll tell you what I'm going to address. That's actually back to the 5C's, and it's capacity and collateral. The first one, let's talk about capacity. I do, as I mentioned, both sell side and buy side M&A work, and this last year I've actually had quite a bit of buy side work. Bit of a trend I've seen there. There's been conservatism on a lending side on a borrowing side from my clients, the buyers, and that dry powder, that ability to borrow more has helped them start to grow again as they're starting to peak on the other side of the pandemic. So I've had a handful of buy-side deals, and one, yeah, I guess we can call it a theme, is they've all been able to borrow because they've kept a reasonable balance sheet throughout the last couple of years. I'll give you an example. This one client, his debt to EBITDA ratio was 3. And he's been managing his numbers over the last couple of years despite a bit of EBITDA volatility, and his actual is 1.5. His fixed charge coverage ratio minimum was 1.25. His actual was 175, and he was able to buy a business less than half the size, and we did it 100% with debt. It was a leverage buyout, and he didn't have to put in a nickel because we were able to refinance his own balance sheet and the target co and keep all the ratios underneath the standing that he had with his current bank, and he was able to purchase something without a nickel from any of his other investors in the equity box. So that the concept of conservatism, keeping your powder dry, has allowed him to grow without really stressing his balance sheet, which is amazing. And so let me add to that. The other piece is collateral. So you heard Danilo talk about the storyline around equipment. One thing that's really continuing to surprise me is the importance of real estate in this market. I had some clients that part of their transactions were buying opcos and realcos. So let's go back to just market statistics. Colliers does a regular quarterly, and as well as some other guys, regular quarterly report on the real estate market Canada-wide. So this isn't our market. This is the Canadian market. Over the last 15 years, the average cap rate, all sectors, all regions, all geographies, went from 7 to 5.5. So that's a drop of 150 basis points in cap rate in the last 15 years. It's notable. More interesting, there's also a gap change between cap rates and cost of capital. The long-term average, there used to be a delta of around 400 basis points. So if you had a 7% cap rate and you're borrowing at 3% capital, well, that started to compress a bit. It actually got as high as 500 basis points. Debt was getting cheaper, but now it's come tighter again at 380. So what that means is cost of capital is again coming up. But what's fascinating is the cap rates continue to fall. So what I'm seeing some clients do is, in fact, locking in this real estate with mortgages that are fixed. We have heard this theme from the other guys on the call, and getting that opportunity of price compression, because of course, as cap rates fall, the value of the property goes up and your mortgage rate is locked. So people are starting to make some bets on real estate, which is fascinating. Now, this is what really surprised me, if you want to call it a surprise. Of the deals, there's about 4 or 5 I worked on buy side this last year. There have been bids I've been getting from several different banks that have raised between 70 to 110% loan to value on the real estate because it was owner occupied and there's enough cash flow coming from the operating business. So what does that mean for the borrower, the acquirer? They were able to buy a business for materially less equity because they were able to over-lever real estate. So there's a question mark there about the sustainability of the real estate prices and therefore the continuing fall of the cap rate. But certainly there's a unique window right now where people are getting fantastic acquisition opportunities because they had limited leverage when they came into the deal. Real estate has really bolstered the market. Banks are supporting real property that are owner occupied, and mortgage rates have yet to move materially. So there's been this window for about this last 6 months, and I'm still working on a few that should close over the next few months, that some guys are getting some pretty good deals on their opco business because it's the back of real estate.
And that's interesting because some of that is longer term plays that they may or may not have done intentional, but I think it's a good point for you to raise today for those business owners and those CFOs that are, starting up businesses, growing businesses, and just that health of the balance sheet and thinking about, what do you want to sacrifice in regards to that balance sheet, and knowing that you're really eating tomorrow's lunch or taking advantage of tomorrow's opportunity when you do that, which may or may not be the right decision, but you got to think of it from a longer term, because you can't fix a balance sheet or have a strong balance sheet overnight by any means.
Agreed.
Awesome. So we are going to ask if our audience has any questions. If you do, feel free to type them to the hosts and panelists, or use the Q&A, and we'll be sure to address them. We've got a couple questions to start. I can't recall exactly which one of you raised it, but someone brought up I think it was you, Dan. You were talking about how as people get busier, along with along with the supply chain, they also have to think about access to people to get the work done, and whether or not those people still live in Alberta, still want to go back to the field and do the work they did pre-COVID before they learned the luxury of Netflix and home, and just whether or not the quantity of those people are there. And that brings us to character when we talk about 5C's and the character and the individuals on management teams and that make up the businesses. And today's newsletter from Amplify was about, businesses in the end are all about people. And we definitely know that at Amplify, but even for capital intense businesses like the one you work down, obviously at the end of the day, that's great that they have good equipment, but if they don't have the people, who's driving that equipment? We're not quite there when it comes to robots, et cetera, right? So what are your thoughts on the impact of this great resignation, character, and people? And what are you seeing with your clients? I'll start with you, Dan, since you raised it a bit in your summary before.
Yeah, well, you can have all the equipment in the world, but until it's fully autonomous, you're going to need people to fix it. You're going to need people to operate it. And those are technical, skilled positions, all of them. And people, you're going to need, despite having a fleet of equipment, really it's a testament to the business and the management, how they retrain and treat their employees, because it is definitely a risk if you're not able to attract that labor. Unfortunately, some of these jobs are outside, 12, a rotation of 14 days in camp. I've had drilling operators tell me, these kids, they don't want to stay in camp for 2 weeks and blah, blah, blah. And, it's a concern to them. There's an underlying concern there that it's not just about getting the contracts. It's not securing the debt and the equipment and the supply chain to once it's all ready to go, they need the people. And there is that concern there. So hey, if you're listening to them, it's going to be a big thing going forward. So the character of a company definitely required in order to attract people and keep that business operating into the future.
Awesome. Chad, OT, anything you want to bring up on the great resignation or the people side when you're thinking about how you can help clients or concerns you have as a lender or advisor?
Conversation I always have is just around I guess the stability, the group of people that the business is working with, and how much has that fluctuated over the last couple of years. And there's lots of companies that I work with that have had to shed some bodies and then hire some bodies back. It's not a conversation I envy at all. It's a difficult thing for a management team to go through. I guess I look at it more from the management perspective, and what are they able to do? Are they able to tap into like a wage subsidy program to keep some of these employees, especially the ones that are hard to replace, as opposed to letting them go? And many that I work with have been able to retain them and use some of those programs, and thank goodness they've done it, because they would have been in a far worse place had they not.
Yeah, that's where the government has definitely stepped up, though it is declining quite quickly, and hopefully the health and safety concerns decline at the same pace. Chad, you mentioned earlier about clients having resilience and adaptability, and being a lot more successful than you maybe would have anticipated back in March 2020, and how incredible that is. And obviously there's some pivots that clients have done, and we don't like the word pivot anymore. It was overused, I know, but at the end of the day, people have gotten innovative and done some pretty neat things. So wondering from the three of you, if any of you have some cool stories just to inspire us of some ideas that we've heard. And I know OT, you told a few already, but I'd love to hear any others that you guys have in terms of those classic pivots of COVID and ways to make more money without spending a whole lot more.
Well, I'll dive in on that, because actually it's a great segue with Chad and Danilo's comments around employment. Like quite often when we talk about these in these sessions, we're thinking about field staff and the more traditional oil and gas skilled labor. Outside of that, knowledge-based industry is growing in Alberta, and others that don't need to be on site. So, you know, when you talk about the Great Resignation, and I've seen it some of the larger advisory shops that I used to be a part of, I keep in touch with, and they're having challenges keeping talent in seat, because they're saying, geez, I remember what happened last time. And oil and gas had happened too. I moved back to the Maritimes or Atlantic Canada. Nope, I ain't coming back. I'm earning less, but I'm not going to live with the volatility. So what I've seen happen, and I'm actually taking advantage of it myself in my own company, Nautilus, we hire out contractors, and now you have a gig economy based business that, as long as you can attract them, compensate them fairly, and quite frankly over fairly compared to hourly rates based off of performance, there's a lot of people that want to be a part of this gig economy instead and make OT Inc. versus work for the same organization that may or may not lay me off. So when you talk about, instead of the word pivot, I call it adapting. What companies can do to adapt is maybe take a look at their fleet of assets and fleet of people. Do I have to buy every asset versus lease? Well, maybe the same questions should be asked about human resources. Do I have to employ directly every asset, or can I outsource? And there are some organizations, quite frankly, that's all that they've done in the energy service space. I know a group where they have highly technical individuals, and they've got hundreds of outsourced talent because they want to be able to flex up and down with the volume of their clients or their contracts. Human assets, elevator assets, are very expensive if they're on the payroll and you can't move them along with revenue. And there are people willing to take on gig economy because they're able to cooper together more revenue without that stability of a biweekly paycheck. And again, certainly I'm taking advantage of that too.
Yeah, and I think you raise a good point when we talk about different ways to be innovative or adaptable, because what you're talking about isn't industry specific. It absolutely can apply to pretty close to every industry. So absolutely everyone listening could be thinking and re-looking at their org structure and their hiring decisions with that lens and some modern finance, modern employment ways of looking at the world, for sure. And that's obviously close to our heart with our fractional offerings and our contract CPAs, and so much of what we do is playing in the gig economy in many ways, and people get what they want at a fraction of the price, and things they couldn't access otherwise. So it can make a huge difference in terms of elevating your ability to access people and get things done, for sure. Any other pivots or adaptabilities or innovation stories you guys want to talk about? Dan, before you're on mute. Good.
Yeah, no, I really like this question because there is a lot to celebrate out there in the marketplace, and there's some amazing people and organizations that have. I have one example, and this has been celebrated online. They are a public company, Zedcor Energy Services. They basically they specialize in well site accommodation, tanks, light towers. And during the downturn, use of the utilization went down. Demand services, the day rates went down. There was a lot of competition, and what they found is, a lot of their clients, they were illuminating maybe the pipelines for security issues, and then they started to put security cameras on there, and they realized, wow, there's a big market in this. So they pivoted from this energy service to a security company, and they're now basically into the tech and just killing it on the security side, utilizing that Rolodex of contacts that they already had for pipeline companies, all those other, and providing site surveillance on their existing kind of light tower platforms. Really cool pivot there that I saw, completely transform the company. Really, really cool on that side. So that's just an example of somebody in the energy service space, still utilizing those contacts, still addressing needs within that, but transitioning over to a tech side.
And, you know, I love that example. Actually, it reminds me of what we're talking about in our CFO group recently is, you know, looking at revenue operating models and how can you earn new sources of revenue without changing your cost structure. And to that story's point, like you're leveraging the same relationships, the same sites that you're otherwise on, etc. And you're not putting on a ton of extra costs or a ton of new skill sets, but you have a whole new revenue source. And now I'm not sure if they're doing it because I'm not as familiar with that story, which is maybe embarrassing if it's all over the news. But you know, they could similarly now take the technology they have with security and potentially go completely out of oil and gas, which again would have minimal extra costs and new assets or new skill sets. So that ability to do things like that, as opposed to chasing yellow balls that are exciting and fun and obviously, you know, really sexy and inspiring, but require a whole new team, a whole new skill set, a whole new set of assets, and just, you know, everything that makes it exciting is also what makes it expensive and what makes it exciting risky. So, you know, it's really important when you look at your revenue operating models of how to diverse and you know, just to be candid with Amplify, that's a big thing that we're always looking at, Jesse and I, and we have 4 services and about 7 sub-services, and they're all different types of contractual flows of revenue. And that is strategically as important to us as anything else that we do, that we have different risk levels at different points of service, but yet all solving the same problem for clients, all fitting within the same brand and using the same basic skill sets and technology and assets. So not to say that we're a success story yet, but it's been very helpful for us and really helps us sleep at night because our risk is diverse along with the revenue. Chad, any thoughts on a story for a pivot or adaptability or innovation? And then we'll wrap this up with final points.
Yeah, well, you know, I've got a lot of examples, but the trend I think that's all of them share is basically, you know, any company that has had a success in the last couple of years compared to maybe years before that have been because they've been able, and this is, you know, whether it's just a symptom of the economy or COVID or whatever, and triggered it, but you know, they've seen success because they've been able to determine a new market, and whether that's having, you know, moving outside of and finding clients outside of Alberta, moving into the States, moving abroad, or they've been able to develop a product or position a product that maybe they haven't done before, which has really improved their margins. So there was a lot of examples that have done for companies that I've seen that have done one or both of those things, and it's really, and it's not an easy thing to do. It's very difficult. But again, that just speaks to you know, kind of the ability of people to navigate these challenges, and it continues to impress me every day.
Yeah, that's an awesome example. So we're going to wrap up. Go back to the heart of the conversation. Our AHA members are either business owners or they're finance leaders, and so I'm going to ask each of you, if you're sitting in the shoes of a business owner or a finance leader, and you want to get financing to support the growth of your business, what is the, you know, key thing that should be top of mind as you prepare for that, as you plan to meet with each of you, as you're telling your story, as you're doing your forecast, etc.? What is that final point that you want us to remember as finance leaders and business owners? Chad, we'll go back to you since you're already on a roll.
I'm on a roll. Okay. I would just make sure that when you're looking at the management team of the company, that there aren't any gaps. You know, you kind of look at the people that you have and you know, challenge the owner of that business. If there is a shortfall, you know, do they need some sort of outside help in some capacity? Are there redundant processes? And because what as a lender, what we're focusing on more than ever is just the impact of the management team and looking at, you know, are there you know, is there a surplus of talent in one area or a gap in another?
Awesome. And that's great. That goes back to character and some of the hot topics we talked about. Dan, what is that one thing that a business owner or finance leader needs to think about in the area of equipment financing and just general ATB's perspective?
Yeah, you know, I want to leave everybody with this one comment, or one example, like, where do you buy your milk? Do you buy it at 7-Eleven, or do you buy at Costco, or one of the big grocery chains? Because you're going to pay a lot different for that same jug of milk. You would pay a lot more, obviously, at a convenience store versus the big grocery stores. And it's amazing to me how many people come to me the day of an auction asking for financing on big number equipment. Hey, we found something. We really need the check, blah, blah, blah. And you know what? You need patience. You have to have your ducks in a row, and you really need to plan ahead for financing, and you'll be rewarded with lower cost debt than going to a convenience equipment finance or debt provider that'll cut a check to you tomorrow. So the 7-Eleven to Costco example, I train my junior RMs to recognize and teach your clients to plan ahead and really start that conversation early. Have that CapEx budget in mind, what you want to buy. We always say, oh, you're buying one truck. What are you buying next? 6 months from now, or how about 8 months from now? Well, like, what's your whole CapEx budget? Let's look at this holistically, and let's get in line. Let's get you the approvals you need, really, to save you money on the financing. So just that one little comment, that 7-Eleven versus Costco, it applies to financing too. Be patient, wait in line, and plan ahead. I think you can save a lot of money.
And that also is a good plug for the forecasting that we were talking about, right? Like, you can't really plan to go to a Costco without a list, because we all know that's a $700 trip. If you don't have the list and you don't stick to it, good luck. And similarly, if you don't have a forecast, which a key part of a forecast is a CapEx budget and a CapEx forecast too. And so that all goes hand in hand. I think it's a good point. And, there's that classic line, but it absolutely deserves repeating. The best time to get financing of any type is when you don't necessarily need it. And the only way that you can do that is by having a forecast and recognizing, okay, I'm in a good spot. This is a good time to get that financing without being desperate. And the day of an auction, as you mentioned, right? That's not a great position for any of us to negotiate or tell a good story. So really important to have the forecast and find the right opportunity to ask for the debt that you eventually need, or that could support that growth, as opposed to when it's the last hour. OT, last words from you. What's that one thing business owners or finance leaders need to recognize when they're coming to you for advice?
Sure. Typically when I'm helping somebody raise capital, whether it be debt or equity, and we'll stick with debt for now, given our topic, the question is why? And if this is just prudent rolling over your maturities, I'll argue the importance of relationship with your current bankers. They know you, you know them, the relationship's been there. And now Chad and Daniil are not going to be happy with me. The transaction's coming. I got an M&A deal. There's importance about competition for that work, the competitive tension of having more than one opinion, because you don't have the option of, okay, refinancing today versus 3 or 4, 5, 6 months with your current relationship. You need it in the next 30 or 60 days. And that really talks to the last of the C's, it's market conditions. There's no question that relationships are important, no question that you should honor the bank that's been supporting you, but it's an insurance policy. If you need that deal done and you're buying another company, you're buying a big asset, you're expanding into a new region, and there is no plan B, you're either going to buy the company or you're not. Insurance policy is having a secondary relationship to know that you're getting an option B, a backup, or competitive tension, best pricing, best covenants, best structure. So I'm talking out of both sides of my mouth. Honor your relationship, but if time is a real crunch, I would always go to market, and that's what I do with my client. I always take them to at least another option. So it's that balance about the market conditions. Be aware that there is always a different appetite from every bank at different times.
And it wasn't planned, but I am so grateful that we ended on that, because it's actually an amazing plug for the book that the four of us wrote, because there's quite a few pages dedicated to exactly what you're talking about, that interesting dynamic of the relationships and the absolute vital importance of treating your bank like a business partner and a partner, but yet also recognizing that different financial institutions at different times have different risk profiles and different perspectives. And so economic conditions and your own conditions, like an M&A, as the example you gave, really can drive the need to look at the competitive tension and the competitive offerings that may or may not suit the relationship that you have. And you can still get a competitive opportunity with a new player and a new partner without damaging or ending the relationship you have with a current partner too. So it's not a black and white, all or nothing situation. So there's a lot of opportunity there. And our ebook does detail that quite a bit. So I do encourage people to take a look at that and to be in touch with any of our experts, or of course ourselves. So obviously at Amplify, if you need help with financial strategy and telling that story and getting your balance sheet in order and getting yourself set up for growth, we can help in all the capacities that we help, from technology and CPAs and CFOs and finance leaders, etc. Otello obviously can be a great source of help when you're ready to actually commit to either a buy or a sell. So his advisory is really pointed in regards to that corporate financing and finding you the transaction that meets your goals and your needs. If you need equipment, I always suggest that you go to Dan. He's very knowledgeable about equipment and very helpful to get you what you need in terms of those assets that are going to leverage, that you can leverage in order to grow. And Chad is one of the best bankers. Biggest surprise of my life that he was so incredible when he was my banker. I just thought he was a nice groomsman at my wedding, but it turns out he's professional too. And it was one of the best.
That's a compliment. I'll just take it as a compliment.
Absolutely a compliment. It was one of the best business partnering relationships I've ever experienced, having Chad as a banker. And it was very sad when he moved to a different bank and I couldn't continue that. So incredibly grateful for all three of you, and incredibly grateful for all of you that attended today. If you have additional questions, please make sure to be a hold of us. And as mentioned, we have a ton of things going on. So check out our website and the AHA page, because that's where you'll get the links. Thursday's Tech Thursday, as I mentioned, which is a demo. The next Thursday after that is why you would need an ERP. And next month is that people process technology talk with our executive leadership team. And then there's on and on with amazing opportunities coming. So really, really appreciative that we get to spend this time together on the third Tuesdays. Thanks, everybody. We'll call
Is Dan
it a
going
wrap.
to take us out on his accordion, or?
No accordion.
Oh,
You should have planned that. Maybe next time.
next time. Yeah.
Maybe the mascot, just the mascot.
Thanks, guys. Soon we'll see you in person, I hope. Bye.